Hey, I'm Charlie's Money and welcome to my channel. Today we're going to be looking at overhead supply with David Ryan on IBD Live. I'm going to be commenting and reacting to this video that describes what is overhead supply, and then looking at the example stock that they talk about now in 2025, almost 3 years after they made this video. By the way, if you want to learn more about value investing, check out my study of Warren Buffett. I extracted tons of data from his shareholder letters from the 1960s to today to try and better understand the strategies and reasoning behind his success. I've pulled historical data from financial statements to try and put ourselves in the shoes of Warren Buffett at the time so that we can have a better understanding of Warren Buffett's decision making when he made some of the decisions that made him the most money in his life. You can also join my Patreon account to learn about my insights of the market on a daily basis and the stocks that I'm watching. Thanks for watching. Please like and subscribe. I learned about David Ryan from reading the book Market Wizards by Jack D. Schwager. David Ryan was heavily inspired by the founder of IBD, William O'Neill. He ended up working for him and then became a 3 times US investing champion. He compounded a return of 1,379% over 3 years, which comes down to an annualized return of 140% from 1985 to 1987. Something to note is that David Ryan does not run any fund to my knowledge, and there's not much information over how much money he has actually made over the years. It doesn't necessarily mean anything because he could be very private, but just something to keep in mind because we don't have receipts for his success like we do for Warren Buffett or William O'Neill. Alright, let's get into the video.
Overhead supply is areas where people bought before at higher prices and could be areas where they might sell if the price rallies into that area.
So David Ryan explains that overhead supply occurs when investors who bought at higher prices may sell the stock as it rallies back to those levels, creating resistance. Remember that stock prices go up when there are more buyers than sellers, and the price goes down when there are more sellers than buyers. So if you reach a price that's below where the majority of buyers of the stock bought it at, it creates this overhead supply.
So now on Tesla, you go, okay, where does overhead supply start? Well, it really, again, I go back to drawing my lines. I make it simple, and I look at lows that the stock has made in the past, and it looks like a lot of lows were made above 756. The last real good rally was off that 756 area. Prior to that, it actually went down to 700 on one day. And then back in January, it hit 792. So I'm saying that the majority of the overhead supply in this is really above, 756.
So in this case, he looks at the example of Tesla and he traces lines along the low of the stock. Since he's tracing the lines at the lows, the majority of the buyers are going to be above the lows of the stock. When you're above the lows, the majority of buyers are fine. But when you pass below these lows, all of these buyers become overhead supply.
And so now once you're below that, you've got now, there's 3 months, there's about 6 months of overhead supply in this stock. So every time it starts coming up into those areas, like 756 and higher, you're being faced with people who are making decisions of, I've been in this stock for 2 months, 3 months, 6 months, and I've been down on it, and now it's come back close to where I bought it, or it actually came to the price where I bought it, and they start thinking, hey, maybe I should sell out of it.
So here David Ryan's giving an insight into the psychology of buyers, which is that since the buyers bought the stock, it has been down most of the time since they bought it. As a result, when it drops below this line, the majority of these buyers in the last 6 months are going to start to look for an exit.
So it's something that's real, that's something that's above you, that you have to be aware of, because there could be selling. It could limit the how far the stock could rally. Sometimes it takes there are two things that have to happen.
He explains that it can limit the rally because since the stock falls when there are more sellers than buyers, if the majority of buyers all convert to sellers because they all want to get out of their stock, it's going to drive the stock price to go down more.
Either it has to take a lot of volume and a lot of demand to push it up through that overhead supply and power through that, or it's got to take time. And that's why a lot of these stocks that we've been going over that are down again, 50, 60, 70%, these things are not going to come back for a long time if they come back, because it's going to take time for those people that bought at higher prices to either finally realize they've got a loss and actually take it. And so that it just takes time, and it takes months, if not years, for a stock to come down and base and base and base, and all that overhead kind of disappears after about a year and a half, and then maybe can reinvent itself, have a new product cycle, and then have another move again. So once the overhead starts piling up, then it just gets harder and harder for it to get through. So
what David Ryan is saying here is that it's extremely hard for a stock to rally back once it passes these lows, because you have so much overhead supply that creates resistance from the stock rallying back. He explains that there are two ways for the stock to rally past that level, which is 1, a lot of volume and demand, or 2, a lot of time. For time, he says that it takes approximately a year and a half for all of the old buyers to realize the loss and to give up on the stock. At that point, the stock may also have time to reinvent itself and launch a new product cycle, because you probably don't want to be in a stock that's down for a year and a half.
And then also, the bigger the volume in an area, the longer time that it's spent in that price range, the longer and harder it'll take to get through it.
David Ryan is making a metaphor. He's explaining that the overhead is piling up, and that the more of it there is, the harder it will be to break through that level. Because the more volume there is, the more people own shares at that level, and so the more people will be faced with that decision of whether they should get out of the stock, since it rallied a small amount. Tesla has rallied a lot in late 2024, so let's see how long it took after 3 years for it to get out of this overhead resistance level. So let's see their chart, which looks like it starts in the beginning of 2020. This looks like this area is the beginning of 2022. So that's this rally right here, and they were calling this as the line of overhead resistance right here. Tesla has gone and hammered and had fallen 75% from its high, but the entire market fell, so that's to be expected since it's a high-tech stock. But you can see David's analysis is correct, because as it rallied back 100%, even though that's extremely strong demand and there's a lot of volume here, it literally hit his resistance level here and rallied right back down. It tested it again, rallied back down, because you have a lot of volume of buyers here. Here is another key level that stood the test of time. It basically took 9 months, October to June, to rally back and test that level, for it only to hit a second resistance level and fail and go right back down. Overall, it took roughly 2 years for it to rally past this level decisively on extremely high volume, because at this point, almost all of the sellers have gone, and that's why it was able to rally so decisively.
Let's go to that AMD example that I used last week. So here's an example of where I was trying to buy on an undercut of the low and down in that area, and it rallied. Look, it rallied right into 100. And look how far 100 is as a resistance. I mean, if David, you can draw that line, just draw a line straight across 100, just to show how long that is. So that, if you count the quarters, that's 6 months. That's maybe 9 or 10 months of price action, maybe even longer than that. Yeah, about 10 months of price action that stock traded above 100.
So now David Ryan's showing another example of AMD where he entered a trade around here right up until it hit this 100 level. But now he's explaining that since there are 10 months of price action below that level, it was very predictable that it was going to bounce right back down.
So you've got all those people, you've got all that volume that it was above there. And you see how it came and it went right into resistance. When I saw it starting to reverse off that the next day, then I sold the whole thing out, because that's a wall. And just think, I mean, I don't know if that's a good analogy. Just think of it as blocks of cement that are just being poured above you, that are hard to get through. And those can be good shorting points too, because you've got that overhead resistance. You also have a moving average. Moving average lines are coming down, and just think of it, it's a weight that is just pressing on the stock that the stock has to power through in either one of two ways. Either the price and volume is super strong, or the time just wears out that overhead supply.
So in this case, he's comparing the overhead supply to a pile of cement that's above the stock. On top of that, AMD has moving averages falling down. He's explaining that there were a lot of red flags in this reversal, which was not only the overhead supply of 10 months, but also moving averages that are ticking down, and that all of these factors combined created an obvious selling pressure.
And the other point too is that that's the advantage of buying a stock when it's going into new high ground. You don't have all this weight above you. You don't have all these buyers above you. When a stock is going into new high ground, and you can just look at AMD when it's coming out of that base at 120, 120, 122 there. There's no one higher. There's no one above you that is saying, hey, I've owned this stock for a couple months and I want to sell if it gets back up to it. Everybody's happy when you're into new high ground. And that's why sometimes these stocks can just run when they get into new high ground. There's no weight of overhead supply on them. So that's
David Ryan's technique is famously buying stocks that make new price highs because there's no overhead supply and everyone's happy that the stock is going up. No one's at a loss and pressured to sell it.
That's something to think about when you're buying a stock at new high. There's no overhead supply.
Let's look at where AMD stock is at today. So this is AMD stock today. It's still around that 100 level. So clearly there's a lot of resistance there. You can see after it passed through that level here, which is here, I believe April. So this part of the chart is right here. And you can see that David Ryan was very correct in getting out at this area because the stock went down another 50% from that point. It took it roughly 11 months to get back to that level. And after that, you had a strong rally on high volume. But ironically, it's come right back down to that point 2.5 years later.
Let's look at another example. If you can go to Shopify, and let's see if I can. Yeah, Shopify. And if you look at the date, let's see, around like the February 1st of this year, the stock broke through. Just a few weeks before that, it broke through 1,000 on to the downside, and so what did you have then? The stock broke 1,000, came down to 800 or 780. And then rallied back up. Well, where did it rally back up to? It rallied right back up under a tremendous amount of overhead supply that started back. I mean, it goes back over a year and a half ago, or a year and a few quarters ago. How many times it hit that 1021, 1005, 1025? So there's another good example of when a stock rallies. Well, what's it going into? It's going into 1, 2, 3, 4 quarters of overhead supply.
For Shopify, it looks like you have huge amounts of sellers here. That's why it rallied here, tested this level, and then right back down. At this point, the stock went down 85%. So whoever was still in this pretty much got wiped out. As a result, the stock has a better chance of rallying. But then again, the minute it hit this level, it goes right back down. Looks like now, 2.5 years later, it's finally consolidating around this level. But it has this overhead supply if these guys didn't sell out here. However, I wouldn't be surprised that there's not that many of these buyers left because they probably got wiped down on this extremely brusque way down.
And then let's look at NVIDIA. NVIDIA, the same thing, just this was actually more recently on... It broke 200, and it looks like 208, 206. You can just draw a line just underneath that area going back over the last 6 months. And the stock broke through it on at the beginning of April, and then on May 4th, stock rallied back up above 200, ran into overhead supply, and it's been down ever since.
NVIDIA has very much been a rocket. This top is this top. It was in a downward trend most of 2022. You have some overhead supply here, which is why it bounced back there, but it broke out of it pretty decisively.
If you own a stock and it's going into overhead supply, it might be a time to just finally cut your losses. It could be a place where you could be shorting the stock. It's also something that you should be looking at all the time. If you're thinking about buying a stock that has been down for a long time, how much overhead supply does it have? You know, even a few points above it, or 10 points above it. You can trade just about anything over a very short time period. But if you're going to be holding stuff longer than a number of weeks or longer than a month or two, you got to make sure you know where that overhead supply is if you're buying a stock that has been down. But most of the stocks that I'm buying, I mean, even the ones we've mentioned, I'm looking for stocks that are closer to their highs and not suffering under the weight of all this overhead. So that's just I think a good quick review of why you don't want to be buying stocks that are down, 40, 50, 60%. You just got a tremendous amount of overhead above you.
That's a great video. Go subscribe to Investors Business Daily. I have a subscription. I use them all the time. Thanks for watching. Please like and subscribe and let me know what you want me to review next.